In section 1.4, we begin to talk about the different ways to classify risks. So we begin with just a quick list of risk exposures. We've got people, their property, or businesses or entities, could be governments. And the simplest way to classify a risk exposure is to talk about whether or not it's pure versus speculative. And pure risk is pretty straightforward because you only have the chance of loss, there's no chance for gain. Whereas a speculative risk, you could have either a gain or a loss. When you think about speculative risks, this is typically what you consider when being exposed to when you have a business or an investment. And one of the reasons that you might care about pure versus speculative risks is that a pure risk is generally going to be treated more easily with insurance. Whereas insurance companies aren't usually interested in speculative risks, but there is some overlap as insurance companies look for new ways to make money. They might tiptoe into the area of covering speculative risks, but generally we think about pure risks being the preferred risk for insurance. The other reason you care about pure versus speculative is that pure risks have more predictability when the law of large numbers is involved. Again, that's why insurance companies like it. They prefer pure risks because you can predict them as long as you have enough of them. Any one driver, even with a good record, can be a problem. They have one bad day. If you're going to have an insurance company with just one driver, that's not diverse enough. You need to have lots and lots of drivers so that you can spread the risk over the entire pool. Because with more drivers, with the law of large numbers on your side, you can better predict the losses and then better set your premiums, and because then you can estimate your claims payouts. There's a number of examples listed in the book, but generally you're going to associate speculative with the thing that it sounds like, which is I'm speculating, which means I'm gambling. Now, I got to go back to something I said before about the law of large numbers and how it generally is more associated with handling pure risks. There is one exception, well, at least one exception, when it comes to where speculative risks can be handled well by the law of large numbers, and that's, of course, gambling. Casinos make their money based on their ability to predict how long it'll be before they turn a profit, for example, at the blackjack table, or at any game, really, inside of a casino. They understand that even though it's a game of chance, that if there's enough games played, that the numbers should be on their side. Now, we'll spend a lot of time in this course talking about personal loss exposures because that's what financial advisors are often counseling clients about. It's like, here are all the things you're exposed to, and here are the ways that you can deal with these risk exposures. And when it comes to personal loss exposure, one of the biggest ones, of course, is premature death if you have people relying on you financially. Sickness, disability, unemployment, all of these things are personal risk exposures that will have a long, drawn-out discussion, believe me, on how we deal with these. A property loss exposure, of course, is going to be either, the stuff that you own, like a house or a commercial building, a car, all of the stuff inside your home. These are all important things to be concerned about, but generally the extent of damage is limited to the value of that thing. And so your exposure your exposure as a result of premature death, disability, long-term care, generally those rack up, those end up being a much bigger risk to you financially than the damage to your stuff. It's possible that you might own something so valuable that it would really be as devastating as a personal loss. And then finally, liability loss exposures. I think this is the biggest, one of the biggest risks of all, right behind, premature death or disability, is in the event that you do have an accident that you are responsible for, and you end up having to pay the damages because maybe it exceeds your liability limits on your auto if it was an auto accident. Then you might be held personally liable for it. So you want to make sure you have enough liability coverage to cover the damage you might do to other people. All right, so the next section I think is a little bit more confusing. Pure versus speculative is pretty straightforward. When we start getting into the difference between catastrophic and non catastrophic, well, this isn't so bad. Catastrophic losses are pretty clear cut. It's a big loss. It hurts a lot of people. It's difficult for insurance companies to handle all by themselves. They usually have to reinsure catastrophic risks. Think of hurricanes, earthquakes. This is the sort of thing that could bankrupt a company. And the losses are generally pretty spectacular. Whereas a non-catastrophic risk is going to be, obviously much smaller number of people involved, a much smaller geographic area perhaps. Then we move into the next section, risks that are not diversifiable versus diversifiable losses, which affect smaller groups, not the entire economy. You can diversify it away. Like, for example, in a portfolio, by holding a variety of company stocks, you can diversify some of the risk that any one company is going to be have bad management. Versus a non-diversifiable risk would be interest rates, inflation, just economic factors that can't be diversified away inside of a portfolio. So everything that you see, let's just divide this. Everything that you see on the left side of the drawing is considered non-diversifiable. And everything that you see on the right side is considered diversifiable. And so let's start to compare and contrast these two. So a fundamental systematic risk, notice systematic versus systemic. We're talking about degrees here. A systematic risk affects many properties. You can't diversify it, which is the same as systemic. It's always present, and it's going to be something like war, earthquake, flood, inflation, market fluctuations, market risk. And sometimes a fundamental or systematic or macro risk, pick your term, they all essentially are referring to the same thing, can trigger a systemic event. And systemic risks are those risks that affect interconnected systems. It can have a domino effect, like the 2008-2009, subprime mortgage crisis, where you have all sorts of players involved in what is a pretty bad market downturn. A pandemic is a systemic risk because, again, it affects so many pieces of the economy that it creates a risk that's really too big to diversify against, and it needs generally government response. So again, all of these are non-diversifiable, can't be mitigated, always present, and you just have to figure out how you're going to work around it potentially. I mean, you can try to have enough cash on hand to be able to weather the storm, but you can't get rid of that risk. Versus diversifiable risks, which are particular, specific, affects few properties or individuals, things like car theft, dwelling fires. Like what we're talking about here are smaller exposures to loss, a car accident, poor management at one specific company, a labor strike. It could even be an industry, but again, this is something that you can diversify away. When we think about this in terms of investing, I'm just coming back to this whole idea of how you can relate some of these risk concepts to a portfolio. You might think about the things that you can diversify by making sure you own lots of different company stocks, from maybe across all different industries or sectors, maybe even, go outside of the United States and own international stocks. However, if you have another 2008, 2009 recession, there really isn't any portfolio that wasn't subject to market risk unless you weren't invested in the market at all. And then those that can't, you're just exposed to the risk and there's really not much you can do. It's not like you can expose yourself to, you know, Mars and Pluto as well as Earth. If you're an insurance company, you're sort of stuck with the risks that we have on Earth. And some of them are so big, you're just going to have to. There are other ways that you can treat the risk, but you can't diversify it away. So many of these non-diversifiable risks are not insurable. Let's take it out of the insurance company perspective and talk about maybe an Amazon or a FedEx or anybody that has lots of physical locations. They might decide to spread out their distribution centers to reduce the exposure that they have to these fundamental risks by making sure that they've got them in locations not only in maybe you're stuck with an earthquake zone, for example, but you could also put one in I don't know, a low risk earthquake zone. I can't come up with one right now because I don't know my tectonic plates very well. Anyways, and here's a handy table that provides you with some examples of diversifiable risks, those that are idiosyncratic, not correlated, that you could, if you wanted to, diversify away, versus those risks that you cannot diversify. So reinsurers can come in all different flavors, but the point is you're essentially backing somebody up. You're saying, look, State Farm, we know that you've got lots of homes insured in California, and if you have a major earthquake, you'll need some help. And so a reinsurer comes in with bags of money only after whatever the agreement is. Let's say, State Farm might reinsure losses in excess of, I'm just going to make this up, 200 million. And then once they hit that, then the reinsurer might come in with their bags of money to help out. Now, they obviously pay the reinsurer no matter what. So it's just like anybody paying for insurance. It's just like, they pay the premium. And you can imagine that the premium goes down if you put your ceiling up. So if you say, look, we'll handle the first 900 million and then we need you guys to step in, well, then the reinsurer isn't going to charge them the same premium. What you should take from this is there are a lot of different ways that you can classify risk, and you will be revisiting these terms, especially when we begin to talk about insuring pure risks, hedging speculative risks, as well as portfolio risk that you're going to attempt to mitigate and measure and quantify in the financial risk chapters, as well as in your investment courses. Two additional terms that you're going to become familiar with: perils versus hazards, as well as the term loss. And then understanding the different types of perils and hazards. So a peril is the proximate cause of the loss, where a hazard increases its likelihood. So a cause of loss might be, a single car accident, whereas an increased likelihood, a hazard that would increase that likelihood might be ice on the road. And the loss associated with that might be the damage to the vehicle, the wage loss for the driver if they're hurt, the damage to the tree or the, whatever the property is that the driver hits, and that would be considered a liability loss. And so when you think about perils, there are natural perils, human perils, and economic perils. And these are probably a little bit more obvious. When you think about natural causes of loss, you think about weather-related things. Human perils are those that, we have some control over as human beings. Not necessarily you have control over someone else starting a war, but it was a human that had the control over that. And then economic perils would be losses that are caused by, the state of the economy, which could be inflation or interest rates or unemployment. And this slide provides you with some examples of natural perils and human perils, and those that are generally insurable versus those that are hard to insure. And the ones that stand out, of course, from a natural peril standpoint that you'll run into pretty frequently, generally insurable, those are no shock. But generally difficult to insure are, the things that would be so devastating financially that an insurance company would generally have to, if they're going to offer coverage, they're going to have to reinsure it. And then human perils that are generally insurable versus difficult to insure. Obviously, war is pretty hard to insure. As well as, terrorism, which can sometimes be synonymous with war, versus those things that are generally insurable. Now, insurance companies don't generally love these, but you can insure against them. We mentioned before that hazards increase the potential or the probability that a loss would occur, also increases their frequency and possibly their severity. And hazards can be defined as being either physical or intangible, and we've been introduced to the idea of moral versus morale hazards. Physical hazards are those things that obviously increase, like something that you can see and observe, the slipperiness of the road, the poor lighting, the bad wiring. Whereas intangible is more attitudinal, perhaps, and can also affect the odds that a loss will occur. The difference between the terms moral and morale hazards, let's just talk about that, because I think of, would you rather hire somebody with, and neither sounds good, but would you rather hire somebody with a bad morale or with bad morals? When you think of bad morale, you think of a bad attitude. You're like, maybe they're just having a bad day. Who knows? Maybe they're just being, careless. They didn't really intend to do anything. They're just sort of knuckleheads, versus somebody with bad morals. A moral hazard is, I'm setting out to defraud you. I'm going to be dishonest and I'm going to be deceitful, versus I'm just sort of lazy. So that's how I think of the difference between moral hazards versus morale hazards. Either way, they increase the probability and potential severity of a loss.